guys, welcome back to the last session of Chapter 4. In this session, we are going to look at estimation issues of capital asset pricing model in reality. Now, the first issue we are going to look at is the time interval. Remember that one of the assumptions of capital market theory is that we assume all the investors are having homogeneous investment horizon. That means the length of their investments are actually equal to each other. So, how long should this estimation time interval be? Now, there's actually no correct or fixed definition for this issue, but we do not want it too short because it might include some of the random effects. We do not want it to be extensively long. We want it to be effectively reflect the reality inside a fixed time period. So we have 3 examples from the famous industrial stars. Now, the Morningstar agency used the monthly returns over the 5 years as the time interval, and Bloomberg used weekly returns over 2 years as the time interval, and Reuters analyzed use daily returns over the past 2 years as our time interval. They all stand a point, but regardless of whichever time frame you choose, always remember you need to match the time interval between risk-free rate, market risk premium, and beta. Now, the next estimate issue is the market proxy. Now, the market proxy or the market portfolio itself is a collective portfolio that gathers every single risky asset or marketable asset on the market. However, it is a theoretical portfolio because we cannot determine all the single investment's value during a point in time. It is simply impossible because we don't know how much risky investment is out there and what is their fair value at a given point in time. So the market proxy is more likely a theoretical myth. But we are being able to look at different market index. For example, in our country, we have Shenzhen Stock Exchange and Shanghai Stock Exchange, and we also have A shares, B shares, H shares. Each can be used as a representation for market proxy. Just pay attention to which one proxy is more suitable for our individual asset risk and return estimation. Now, the next estimation issue is when we say we are able to borrow and lend unlimited amount at risk-free rate when we form the capital market line. Now, we say that it is always possible to lend at risk-free rate by buying treasury bonds. However, we do not always able to borrow at risk-free rate. A more likely case is that we are being able to borrow or introduce leverage into our portfolio at a higher borrowing rate there, which is higher than the risk-free rate. Now, with doing so, our capital market line break into 3 parts. Now, from alpha to F point, what we do is we invest in risk-free asset with various weight in combination with point F. Now, when we graduate F from K, we do not introduce any leverage into our portfolio. This is the part where we are not risk tolerant enough to introduce any leverage. And from K point and above, this is when we are risk tolerant enough being able to welcome leverage into our portfolio. Now, from the K point above, we are being able to borrow money at RB rate and then use the proceeds and the money we have all instead into this K portfolio. Now, from alpha to F, we are lending our money out yet not being able to borrow money at risk-free rate. Now, what happens between F and K is we change our
choice of
efficient investment portfolio on this efficient frontier. This FK is actually captured from the efficient frontier, and we change the location between F and K based on our risk tolerance level. And from K point and above, that's when we start to introduce leverage. Yet, noticing that this K part represents a less profitable investments compared to when we can borrow money at risk-free rate. So when we are introducing leverage, we also introduce higher risk compared to when we can borrow at risk-free rate. So that's the three components of the changed capital market line. The first, when we do not introduce leverage. The second, we still do not introduce leverage, but we change our risk tolerance level to find the next location on the efficient frontier. And from K point behind, that's when we introduce leverage. Easy as that. But this slope is smaller than the slope here because the intercept is here, which is given by the borrowing rate. Larger intercept, smaller slope. Easy as that. Now, let's relax some other of the assumptions. The first is transaction cost. Well, we say that transaction cost is likely to be free for, let's say, some financial institutions, but it is not possible for individual having no transaction cost. So that means when some misprice happened, investors may not immediately correct this misprice because the presence of transaction cost might eliminate any chance of excess return. So it means the investor would target very closely to security market line, yet not exactly on it. So now the security market line will become not a straight line, but a band. And the width of that band depends on the amount of transaction cost. If the market is booming, there's lots of financial agencies, there's a lot of active brokers, then the transaction cost is likely to be lower, which leads to a narrow SML band. Now, let's see the assumptions of homogeneous expectation and planning period. In our assumptions, previous assumptions, we say that the investors all hold the same expectation for the probability distribution of expected return, and they all have the same length of planning period. Now we relax these two assumptions. Investors, if they form different opinions about an investment future, that will expand the scope of security market line. It will become a band of security market lines. And how wide this band is depends on how different the opinions held by investors. Now, if investors are holding, let's say, similar, not same but similar expectations, and they have similar level of skills and experience, and they have the same access to similar information, then that scope of the band of the security market line is likely to be narrow. However, if the variations in investors' expectation are very, very large, then the scope of this band of security market line is likely to be very large also. And the last issue I would like to mention is that the return we get, the required return we get from the capital asset pricing model, the CAPM, is pre-tax return. In reality, we need to pay tax on capital gains and dividend, and the tax rate on these two incomes are actually different. So pay attention to this issue when we do reality analysis. So the last issue we are going to talk about in our session is the beta. Now, beta is a direct product of market turbulence. We calculate beta using the covariance between individual asset and market, and we standardize this covariance by the total risk of the market proxy. Now, we say that there is many proxy for market index. We say there's Shenzhen Stock Exchange, there's Shanghai Stock Exchange. All can be a single individual
independent
market proxy. So when we change our market proxy, our beta is going to change. Now, for individual beta, compared to portfolio beta, where the individual change trend in beta is likely to be balancing out, the individual beta is less stable. The portfolio beta with the individual trend being cancelled, it is likely to form a relatively beta observation. Now, the larger the portfolio, the more likely the individual beta trend is cancelled out, and the longer the investments, the stable the portfolio beta. Now, that's some of the features of the beta. And also, like any statistic observations, the dots on a normal distribution from two tails is going to travel in the middle into the presence of mean. What we see in beta is that if we are looking at the data long enough, we are going to see the high beta travels back, means that it lowers its beta towards 1. And for investments that are lower than the beta of the market, that's beta equals to 1, it is going to move upwards, close to the average market risk, let's say the population market risk presentation that equals to 1. So they are mean reverting. So that's what we see if we observe a long-term beta changes. Now, that concludes this very hard yet interesting chapter. In this chapter, we first introduce the capital market line as a development of the efficient frontier. And we form this capital market line by a two-asset portfolio, with one being the risk-free asset, the other one being the market portfolio. And we also find that given by the investment choice along capital market line being the only investment choice, that's the market portfolio, and the financing decision that we are going to lend or borrow gives us the final position on the security market line, leads us to know the separation theorem. That's the separation or independency between financing decision and investment decision. And we also learn about risk diversification. It means that we can only get reward for risk that cannot be diversified away. That's systematic risk. And we do diversification to form a portfolio where this portfolio will not be holding any individual risk. And we also introduced the second line of this chapter, that's the security market line, as a linear form and graphic form of the capital asset pricing model. And we see how the undervalued asset being present above the security market line and the overvalued security plot below the security market line. All right, that concludes this chapter. Thank you for joining me. I'll see you next time. Bye-bye.